Perfect. Well, welcome back. As I was telling you, it's a pleasure to have you here with us. Today is week 3, so fast, of our financial education summer series. And we're going to be covering a very important topic. We're going to be talking about interest. We're going to understand interest together. And we're also going to be talking about how we can better manage our debt. For this session, we have a special guest. His name is Enrique Castro. And let me tell you a little bit about Enrique. He is one of our business advisors here at Weave. He is also the co-founder of BH Ventures, which is a consulting firm that serves Black and Hispanic businesses through consulting services. And he's also the founder of an economics podcast in Spanish called El Taco Financiero. He's an economist and mathematician as a professional, and he has worked over 5 years at the Mexican Treasury. So he's so knowledgeable about a lot of the topics that we're going to be covering today. So we're very excited to have him here with us. Enrique, how are you? Welcome.
Thank you, Erin. Good night, and thank you everyone for being here. I'm excited about the topics that we're going to be discussing today.
So let's jump to it, shall we? The first stop on today's session, as we have talked in the past, in our financial life, there are going to be a lot of topics where if we don't know the rules of the game, it's going to be very hard for us to have a good time playing the game. And that analogy applies in particular when we're talking about debt. So when we talk about debt today, we're going to be dividing the subject into 4 different items. So first, we're going to be talking about how interest works. Then we're going to talk about how credit works. And lastly, we're going to talk about debt management strategies that ultimately are going to allow us to use debt as a tool. As we've talked before, money, especially when we start talking about debt, that can be an emotional and stressful topic. So as we've shared before, it's going to be important for us to be patient with ourselves, compassionate with ourselves in this journey, and also focus on what we can control. And that's why today we're going to cover this subject, again, approaching it as, if we want to play the game of debt, what do we need to know about it? Okay. So without further ado, I'm going to pass the microphone to Enrique so that he can talk more about how interest works and go more in depth in regards to interest. Enrique, take it away.
Thank you so much, Erin. It's a pleasure being here, and good night, everyone. We are going to be talking about a really important topic that we suffer or benefit from on a daily basis, and we normally don't see it that way until it's costly for us. So interest, we can define interest as the cost of using somebody else's money or the benefit of letting someone else use our money. We're going to be talking about the first component on this session. One of the sessions later in this course, Erin is going to be talking to you about investing. So the second part of letting somebody else use your money is going to be taught in that session. But for now, let's talk about what is the cost of using somebody else's money. We use somebody else's money for a lot of things, and it is not a bad thing. Sometimes it's a taboo to talk about debt and having debt or asking for a loan, but it's something perfectly normal in everyone's goals in life. For instance, if we want to buy a house, we normally request a mortgage from a bank or from a financial institution. So we're basically paying an interest, even if it's a small amount of interest, for using that money to purchase our dream home. Or if we need to purchase a car because now the family is bigger and we need to have an additional vehicle, we can also buy it in cash, or we can buy it through a loan or a lease. Either of those, it is a form of debt that we normally use and that requires for us to have a good credit, and we're going to be talking about why that is important. Some durable goods, for instance, if we need to buy appliances, we need to replace a washing machine or a dryer, these things normally we can also buy them in cash, but we can also use credit, we can also use a loan and pay interest to buy those. And we have a lot of instruments to incur into debt, and we're going to be talking about them in a slide a bit later. Just briefly, the benefit of letting somebody else use our money could be we lend someone that wants to start a business, or we use put our money into the stock market, or we put it into a retirement account. So basically, we're putting our money, letting somebody else use it, and we're going to receive an interest in return. So talking about the first component, the cost of using somebody else's money. If we ask for money to a relative, he's going to trust us that we're going to return the money. But if we are asking for a loan to a stranger or to a person that we don't know or to a bank, how can we convince the other party that we will be responsible paying our debt off? So we have several options. One could be promising him that we're going to pay our debt, giving him some references so that they can talk with our references and say, hey, this person is a responsible person managing money and debt. But the main, and even if it's the main instrument, it is not necessarily the perfect instrument. The main instrument that the financial industry has to convincing financial institutions to lend money is the credit report and the credit history that we have as an individual. So this is something really important. And can you go to the next slide, Erin? Thank you. So we're going to be talking about understanding credit, and this is going to be divided into two subtopics. One is understanding our credit report, and the other is understanding our credit score. So credit is basically a way for lenders or people that want to lend us money or people that want to check on our history to know how good or bad we manage debt and our ability to manage it. It can be a really powerful tool or a great obstacle to achieve our financial goals. And credit is used in a lot of things. For instance, if we want to get electricity to our home and we're going to switch providers, they may check our credit and they may require us to do a security deposit, which had happened to some of us because we don't have maybe the best credit, and they want to make sure that we're going to be able to pay our bills responsibly. So responsible use of credit demands for organization and regular monitoring of our budget and expenses. And as I was mentioning, it is measured through the credit score and the credit profile. So the credit score is a numeric amount, is a number, 3-digit number. It ranges from 300 to 850. And what you should know about it as a history context is this was created in the previous century, and it was created originally by two mathematician and statistic experts called Fair and Isaac. They created a company called Fair and Isaac Company, which translates to FICO. This was a score that evaluated our ability to pay. Then with the big credit bureaus that we normally know, which are Experian, TransUnion, and Equifax, they created another score which basically measures the same, our ability to pay and how responsible are we to pay our debts. If you have a score of 800, basically everyone is going to be willing to lend you money because you have a score so high that shows that you are a responsible person managing debt. If your score is a 400, maybe some of them will be willing to lend you money, but at a higher interest rate because you are considered a more riskier borrower. So that can help us or can hinder our ability to achieve our financial goals because we can be asked for more requirements or to pay a security deposit, or we can be asked for a cosigner. We're going to be facing hurdles in our financial goals if we have a low credit score. So this is really important, and it's going to impact our ability and our family's ability to secure our goals in life. There is also another score for businesses, which is the business credit score. It is measured differently, and it is not regulated the same way as personal credit scores. So what you should know about these two is the personal credit score. It is a score that measures the individual ability to pay debt, and the business credit score, it measures the business ability to pay to its vendors, to its lenders, and to manage debt as a business. So it is something that it is really important if you are an owner of a small business that you separate your business from your personal history. And with Irene, we have had the opportunity to talk about this in Spanish previously here with Weave. So it's really important that you separate those two, not only because of your credit score, but also because of any personal liabilities that you may face, and any organizational structures that you could have in your business. So it is really important that you have those separated, but that is out of the scope of the current session. What are the main factors that impact or create or make your credit score? As we show here, it's on-time payments. This represents over a third of the components of the score. So making payments on time, it is crucial, whether it's a student loan, whether it's a credit card, whether it's a auto loan that we have, and we don't even have to mention mortgage, because that is the biggest amount of money that we're gonna probably borrow in our lives. So it is crucial that we make on-time payments. And with the pandemic, a lot of people weren't able to do so. And the banks, some of them were able to offer deferral terms or defer payments. The student loans also had some deferrals backed by the government. So there were some things to help people navigate the pandemic. But basically, if you miss a payment on time, that is gonna be hard for you to get back on the score that you were. If you miss one payment, normally it takes at least 6 months of on-time payments to get back to where you were. So it is crucial for you to make on-time payments and have this as one of your main goals in managing your debt. How much of the credit we utilize is also a big component. This basically measures the credit utilization that we have. For instance, if you have a credit card that gives you a line of credit or a line of $1,000, if you use 500 of that, then your credit utilization is 50%, because they measure the balance that you have divided by the amount of credit that you have available. Another component is the credit history. How long have you had credit in your life? This is a reason why some advisors normally say that you shouldn't close your oldest account, because that helps have a longer credit history, and that also helps you have a better credit score. Also, recent searches for credit is a component that is important. When we go to a department store and we receive an offer that says, hey, you can get a discount if you apply for a credit card, that is considered a hard inquiry. And this is a distinction that we have to make talking about credit, because it's really important. A hard inquiry is when we authorize somebody to check our credit. If we apply for a mortgage, if we apply for a loan, if we apply for a credit card, we are basically telling the institution that we authorize them to check our credit so that they evaluate our credit worthiness. And this is going to impact our score. It can decrease our credit score 10 points or more, depending on the situation, but it represents a hard inquiry. The other type of inquiry is a soft inquiry, which basically is an inquiry where the lenders, they do not ask for our authorization, and we do not give authorization for them to check our credit, but they use it to give us some pre-screened offers or some pre-approved offers. If somebody in the audience has received any pre-approval offer in the mail saying, hey, you are pre-approved for this credit card, or you are pre-approved for this personal loan, that means that they checked your score, but that didn't impact your credit score. They just reviewed it to see if you were a good fit for their business model. And when they send you that, they tell you that if you want to move forward with the offer, you have to sign an application, and that's when you authorize them, and that is when the inquiry becomes a hard inquiry. So you gotta be mindful of which types of inquiries and which type of authorizations you're giving in your daily life, because some of them may impact your score and some of them won't impact because the businesses and the lenders use it to offer you products or services. And Erin, can you move to the next one, please? So some of the advices that we normally give to people that to help them improve their credit scores, the main component that we were saying is pay your debt on time. We cannot stress this enough, and Erin is going to talk later in this session about some of the strategies that you can have about managing your debt and paying your debt. But paying the debt on time is crucial because it is going to give consistency to your credit score, because each of the accounts in your credit scores are going to be showing at least the last 24 months of your payments. So if you miss a payment next month, that is probably going to be shown at least until June of 2023. So that is going to have an impact of any credit, any loan, any financing that you look for in the next 24 months, and the records in your score normally appear and stay in your score for 7 years. So you got to be really careful about those things that can impact your score. The second suggestion is to keep your credit balances low. As a general rule, a rule of thumb is to not have a credit utilization above 30%. I would suggest to try to go even lower, try to make it at least no more than 10%. What this means is you can have you can use your credit card as much as you want, but credit cards in particular have something that is the cutoff date, or the date that where they take the balance and they create your bank statement. When you receive a bank statement and you see in your statement you have this balance in your credit card and you have until this date to pay, that is the balance that you should try to keep low by that time in the month. So if you have a $1,000 credit card, try to keep it under $100 if possible, because that is going to help you also increase your credit score. The third one, which is really important that Irene mentioned here, is avoiding unnecessary borrowing, and that is really important. When we are looking for when we have an emergency, for instance, or when we want to make a purchase that we know is going to be manageable with our debt burden, it makes sense for us to look for an additional credit card or to look for a loan. But if we want to go on vacation, or if we want to buy the new iPhone, we don't we have to be mindful that if we use this, or if we get these products, or we go on vacation by incurring into debt, that is going to create a burden for our families or for us in the future, because we have to pay that debt normally with interest. So we're going to have a greater income in the future, or we're going to have enough cash flow in the future to be able to pay this debt, because we're going to have to be paid. This has to be paid eventually in the future. The fourth advice is to monitor your credit on a regular basis. And this is really important because it is estimated that at least 1/3 of all the credit reports in this country have at least one mistake. So you should manage your credit on a regular basis, because you may find that there is an account that is impacting your credit score and it is not even yours. So you can go to the credit bureau and say, hey, there's a mistake in my credit report, and they have to correct it. If they don't correct it on a certain period, the law backs the consumer, and they have to take that account out of your credit report. So it is really important that you manage it. And if you find a mistake, contact your credit bureau, because they have the duty to help you correct that and take that out of your credit report. So it is really important that you monitor your credit regularly. There are tools that Irene is going to share with you guys so that you can monitor your credit. By law, you have access, free access once a year to your credit report for each of the credit bureaus. But with the pandemic, the credit bureaus have made it available at least once a week, free for all of us. So you can go to Equifax or Experian or TransUnion to get your credit scores, and you can even monitor your scores right now with a lot of apps. You can have your own Experian app in your phone. You can have your bank mobile app is gonna allow you, is gonna offer you also to track your credit score. So there's a lot of ways right now using technology for us to know where we stand in this range of credit scores, and how can we improve those over time. So it is really important, and we're entitled, as Slide is saying, to request one report per year for free for these organizations. But it is at the end a reflection of our own personal financial habits. This is why it's really important for us to be clear on what we have, what is our income, what is our liabilities, what is our expenses. And Irene is going to be talking during this month a lot about these topics, because it is really important that if we have a strong standing, a strong foundation of our personal financial decisions and family financial decisions, that is going to be reflected not only in the health of our relationships with the people, but also with our financial relationships with banks and with lenders. And it's going to be easier for us to achieve our financial goals. As we were saying, this is really important because we all have goals in life. We want to have our own home, we want to have a new car, or maybe we need to do a big purchase. So for some things, it's going to make sense for us to incur into debt. But if we incur into debt, we have to make sure that we have a good standing on the credit side so that financial institutions don't charge us a big interest when we have to incur into debt. Because if the same person with the same income, with the same cash flow, with the same characteristics has a bad credit score, is going to pay a lot of interest for this, and that's going to be the only reason that is going to make that person pay a lot of interest, because he wasn't careful enough, or he wasn't fortunate enough to take care of that on an ongoing and consistent basis. So it is, as Irene always mentions as well, it is a game of patience. It is a game of patience. We have to be mindful, and also we have to be comprehensive, and we have to be empathetic on this, because it is not something that is done in one day or in one week. It requires patience. It requires consistency, and it is something that we all can do. Even if we came to the United States from another country, that is something really hard, because sometimes we don't understand how the system works here, and we have to learn the rules of the game so that we can play by the rules and also be able to achieve our financial goals. If we came from another country, it is not, we're not forbidden, and we're not limited to achieve our goals in here. So we can also achieve our financial goals, and we can also achieve our personal goals in this country, but we have to know the rules of the game and follow those rules of the game. Irene, I don't know if people have questions. Maybe we can
Yes.
take some of these questions, because it is a really important and complex topic.
And we do have some questions. So the first question was if we recommend using organizations such as Credit Karma, and in the chat I shared with you all that we do. Credit Karma Mint also helps you monitor your credit. At the end of the day, it's about finding what works for us, right? If it engages you, and somebody shared, for me, it worked like a game. That's exactly what we're talking about, right? It's about shifting that mindset. Let's make it a game. Let's also, I would like to add here, understand that sometimes our credit score, it's easier for it to go down than for it to go up. So it's going to be important for us to be very patient in this game. But if we stay disciplined, there's where there's a will, there's a way, right? We've talked about this before. And we do have two more questions, Enrique, but is there anything you would like to add in terms of that organization, Credit Karma?
I think, as you were saying, there's a lot of tools, and I think what we can use a tool that we find best for us. Some of them are going to have different user interfaces, are going to be more user friendly. Maybe we'll be able to suggest you credit cards, or we'll be able to suggest you some strategies to budget better. So at the end, it's going to be what you think it's best for you given your situation. But definitely there's tools like Mint or Credit Karma that are really good. I use Mint, and it helps me a lot, because in one window, when you connect your bank, it shows you all of it. Like, how much are you spending on groceries per month? How much are you spending on going to the movies per month? And at the end, it also helps you know if you're ready to apply for a new credit card or not. So they also give you tools and suggestions on that.
Thank you, Enrique. And one question we had in the Q&A: can a sole proprietor establish a separate business score?
This is a really interesting question. Thank you. This is a really interesting question, Tatiana. Thank you for it. You cannot establish a business score with your sole proprietor, and the main reason is, when you have a sole proprietorship, you are having a business that is run or is backed by your social security number, to put it one way. If you create a business, you create an additional or a different tax ID or a legal entity that is going to operate with the business or the service that you are providing. And then you will be able to have a business bank account and all of those business vendor relationships that will allow you to create your own business credit history and business credit score. So the best tool to create your separate business credit score is to establish a separate legal entity that is going to be your business, because that is going to use a tax ID that is called Employer Identification Number, or EIN. And that is what business bureaus are going to use to create and to report your credit history. So the answer would be no, but it's entirely possible that we establish this business score by creating a separate legal entity for our businesses.
Thank you, Enrique. Another question we have, does your credit go down when you open a new credit card? And if so, please explain why.
Yes, it goes down, Nicole. Thank you for the question. It goes down because when you are applying for a credit card, they are going to perform a hard inquiry on your credit file. As we were mentioning earlier, we have two types of inquiries. The hard inquiry is when you apply for credit or for funding or for a loan, and you authorize the lender to review your credit score to evaluate your credit worthiness as part of their underwriting process. If you don't authorize it, then it won't impact your score. But normally when you want to apply for a credit card or a loan or a mortgage, you authorize the lender to perform this hard inquiry, and it's going to impact your score. The specific amount, it varies, but it could be from 10 points down to bigger depending on the situation, but it does go down.
Perfect. And once it goes down, if you use it responsibly, if it adds to your credit balance and you're not using it, do you know, Enrique, if that kind of helps you go back to where you were when it comes to your credit score?
Yes, it helps to go back, and again, it depends on the individual situation, how fast can it go up again. I'm going to use me as an example. I applied to a credit card last November. My score went down 10 points, but I think it was 2 months after it or 3 months after it, I was back on the level that I was before applying. And I gained the fact that I had a lower credit utilization because I don't use the entire balance or the entire credit that I have access to with this credit card. So it takes, I would say, at least 2 or 3 months to go back. But it depends on the situation, because if, for instance, you miss a payment in that period, well, it's definitely going to take longer because you're going to have an impact down on your score. So it does go down, but it can go up fairly easily if you continue to be consistent with maintaining a good score.
Perfect. And another question we had, Diane mentioned that Credit Karma has been recommending her to get a specific credit card to build credit. Would you consider that a legitimate use of a credit card to build credit?
You can, and this is how a lot of people that come from another country start. For instance, in my case, I used what is called a secured credit card, which I imagine some in the audience may have used one or had one in their past. Basically, what they do is they ask you for money as a collateral in case you don't pay, and then after some months, they give you that money back and it becomes an unsecured credit card. This is something that we have to normally do when we don't have any credit history and we want to start. That is one of the ways that a lot of people start building credit. Regarding a specific credit card to build credit, I would say it's going to depend on each person. There is no best card to start building credit. Some banks are going to offer you the secure card. There are other tools as well that I would mention that. For instance, there's a company called Self-Lender that they offer you a savings account that is at the same time a credit building account. And this is something that is really interesting because to me, because it helps you create a financial habit of saving money on a regular basis. And at the same time, they report these to the credit bureaus as if it were a loan, so that you build credit and you are getting reported credit positively, and you're saving at the end of the period or at the end of the term. They're going to give you your money back minus their commissions that they charge, but you were reported a good standing credit account in your file, so it also helps. So at the end, it is going to depend on which one do you like. If you already have a banking relationship with a specific bank, it is normally easier to get a credit card with them. Just be mindful and talk to your banker, because that is also a good piece of advice for people that have businesses in this audience. Having a business banker relationship is crucial because they can let you know if you apply or you're eligible to an additional type of funding. They also know how the local economy is doing, if a lot of businesses have been opening bank accounts, if a specific industry is thriving or not. So it is really important to you to have a good relationship with your banker. And even if you don't have a business, going to your banker or talking with him and saying, hey, I have these financial goals and I want to do this and this. What would you recommend me, or what would you suggest me to do? It is always helpful to hear from a banker's perspective.
Enrique, where do people check their business credit score?
You can check your business credit score with the credit bureaus, and this is one of the differences in regulation when comparing to individual credit scores or personal credit scores. Anyone can check a business credit score. I can go online to Experian, for instance, and look for one of the businesses in the audience, and I will get, if they have a business credit history, I will be able to find it. And obviously I have to purchase it and I have to pay the bureaus to get access to it. But business credit scores do not require the authorization of the business owner for anyone to purchase them. And the main reason is they are not regulated under the same laws that regulate personal credit history. So it is, in a sense, a newer development in the industry. So they are not regulated the same way. But you can go to the websites of the credit bureaus and access or ask for your business credit file if there's one available. The best way to start building that credit is obviously having a separate legal entity, having a business banking relationship, and also registering your business with Duns and Bradstreet, which is globally the main hub or the main information repository for business credit. And this is something that you are going to need also if you are thinking about, for instance, getting contracting with the government. You're definitely going to need a Dun and Bradstreet number. So it is something that if you're thinking about it, it makes a lot of sense to do so.
Okay, and we do have several questions, and I want to make sure that we have plenty of time to cover all our content. So before we move forward, I have two questions that I want to ask you, Enrique, and the other ones, you're going to cover some of them in the next slide. But one question that came up was around, does a secure credit card affect your credit score when starting it?
The secure credit card, if you apply for a secure credit card, it is at the end a hard inquiry as well. So by definition, it would affect. But the secure credit card is something that is normally offered for people that do not have any credit history. Like when I started 2 years ago, I didn't have any credit history, but I did have a personal checking account. So I applied for a secure credit card and I was approved for it. But since I didn't have any credit history, there was no score to impact. So it didn't impact me because I didn't have any score. But if you do have a credit score and you apply for a secure credit card, it is going to be a hard inquiry and it will impact some points in your credit score.
And then another very interesting question we had. Cristina mentioned that she heard about some parents opening up credit cards for their children so they can start building up their credit. Have you heard of this? Is this a thing? And we've talked about this before, so could you tell us a little bit more about that?
When they're older, they will have a credit history. Yes, this is really important, and it is something that, as you were saying, Erin, we talked about it a lot. It is crucial that your kids not only start having credit early on, but also understand how to manage money and how to manage debt and how the system works. Because if you help them to build credit by adding them as an authorized user in your account or by having a credit card for them, they're going to have a good credit. But when they go to college or when they're in high school or when they are living in another town, if they don't know how to be financially responsible, it's going to help them to start, but they're going to be impacted eventually if they don't do sound financial decisions. So I would say, yes, it is useful. Some banks even allow, if you have children of 12 years old, to start adding them as an authorized user so they can start building credit at the age of 12, which is amazing to me. I don't know if in Mexico we have something like that, but it is something that is really interesting here. And it depends on the bank. Some banks let you know that you have your kids as an authorized user at certain ages. Some of them don't have any age limitations. So I would again say, go to your banker for any bank that you have right now and ask them how would it work, and if you are allowed to add your children as an authorized user. It is something that I do recommend because as an immigrant, it is hard to start from scratch at an older age. So it is definitely something that is worth trying. But at the same time, I would suggest combining that with sound financial education and practices, sound practices to teach them to manage money and to manage debt responsibly, because that is gonna help them even more than having credit, because you're helping them building sound financial habits for when they're independent or when they're older. So
Amen to that. Always complement with financial education so that they can also know the rules of the game. Thank you for that, Enrique. And we're gonna keep going, and we're gonna get back to some of these questions at the end. One thing I want to share, thank you for sharing all the resources that have helped you in the chat. I'm gonna add those to the email that we send with the recording afterwards. One person suggested an organization called Self Lender. So thank you for sharing that. We're gonna add it to the list. And also, Edith mentioned that she has Credit Karma. She has a card from them that helps her build up credit and also a savings account. So there's a lot of resources that we're going to encourage you to explore. And there's another resource that we've shared in the past called Nerd Wallet, where you can compare different credit products so that you truly take the time to research what's going to work best for you, right? So without further ado, I want to make sure that we cover types of debt, because some of the questions were associated with the slide. So Enrique, please tell us more about types of debt.
thank you, Erin. Well, now that we talked about credit and about how to have a good credit and good and sound financial decisions for us to manage and maintain this good credit, I want to share with you some of the main types of debt that we have and some of the limitations and when should we consider it. I sorted them from the biggest annual percentage rate, or APR, so that you can know how outrageous this is. I think it is outrageous that financial institutions charge this amount of APR for a loan. And the worst one, in my opinion, are the payday loans or fortnight advance loans. These are 15 to 30 days term, and the APRs cannot go up to 600%. And you can research that, you can look for it. If you have one and you want to look at your contract, you're gonna be surprised. So I don't recommend these ones. The only thing that maybe I would recommend it if you have an emergency and it is a last resort. You don't have anything else, nobody can lend you money, you maxed out your credit cards, you are not approved for any other credit, maybe that makes sense. But definitely I would not recommend them, because not only they charge you a lot of interest rate, but it is not reported to the credit profile. So if you pay it and you pay all that interest and you are responsible paying that payday loan, it will benefit you, it won't benefit your credit score. The other two that don't benefit your credit score or your credit history are the title loans and the pawn shops. These have lower APRs, and with lower, I mean still outrageous, from 180% to 300%, and they should also be used as an emergency and as a last resort. Then when you start having some credit history, you can have personal loans, which could be really useful for some big purchases or planned purchases. For instance, if you're gonna have, if you need surgery, or if you are planning a big expense, or you suddenly need to replace an appliance that you need to replace, I would recommend those. If you have a good credit, you can have interest rates as low as 10%, even lower in some cases. But if you do not have a good credit, you're gonna have APRs up to 170%. And these loans can be from 1 month to almost 5 years. Each state is in charge of regulating the amount of interest that you can be charged with these loans. And I would recommend them, but also I would ask when you apply for one of these, if the institution reports their loan or your loan to the credit bureaus, because some of them don't report, but most of them do report your loan to the credit bureau. So it helps you if you pay it on time and you're responsible. It helps you improve and create credit history. Then go the credit cards, which are revolving type of account or loan. We are familiar with this type of loan, and the APRs go as much as 60% in countries like Mexico. and it can go below even 15% here in the US. I would recommend them for current expenses that you can pay at the cutoff date, or for some purchases that allow you to have interest-free installment payments. Some credit cards even let you know that you can buy something big and pay it with no interest for several months. So that can also make sense. And also, basically, all of the credit cards are reported to the credit bureau. So it also helps you build your credit and maintain a good credit if you're responsible with those. Then go the car loans, which can go from 3% to almost 20%. And these, I would recommend them when they are realistically required and able to pay. I would recommend them because they are also reported to the credit bureaus, and all of the ones that are reported to the bureaus are going to require a hard inquiry. So be mindful of that as well. Finally, one of the goals that most people have in life, one of the biggest goals that we have in life, is to have our own home, our own place. And these are basically really long loans from 15 years to 30 years. And if you have a really good score, you can have a 2.5% rate. Right now, the rates are really low, are at historically low rates, but they can go up if you have a bad credit score. So that can translate into a really big difference. If you have like a 0.5 percentage point difference in your mortgage rate, you can pay, it can represent at least $15,000 or $20,000 in interest that you're gonna pay over your loan term. So having a good credit is never a bad strategy. And these are obviously these are also reported to your credit history with the bureaus. So we wanted to show you this so that you can be mindful of, maybe you have some of these loans or some of these types of debt right now. Maybe you know someone that has these types of loans or debt. So you can give them some advice as well on which makes more sense and under which scenarios, which can benefit their credit scores, which cannot, and which are basically outrageous in the rates, and you should try to avoid as much as possible.
Thank you, Enrique. Thank you, thank you. And I see some more questions in the chat. So we're going to leave some time at the end so we can get to all of your questions, we promise.
Awesome.
So here, Enrique, is there anything you would like to add before we start talking about kind of what's the mindset behind these types of debt and what can we do, focusing on what's within our control when it comes to managing our debt?
I would stress again that this is a game of patience and a game of understanding, because if we have a lot of debt right now and maybe we're not able to pay all of it, or we're not able to pay all of those monthly payments, there's always strategies, there's always a solution. It is not everything is not lost if we're not able to pay everything, but we have to have a strategy. And this is why I love this type of webinars and courses, because you, Erin, work really hard to show what can be done, what strategies can we get, even if we don't have maybe income right now, or even if we don't have a clear way of getting out of all of that debt. There's always a strategy that we can follow to gradually take steps, incremental steps that would allow us to be debt-free, or we allow us to have a better credit profile. So I would stress it is a game of patience and understanding. So be mindful. It is something that takes time, but we can all do it, and we can all achieve our financial goals by being consistent and by being structured in our goals.
Yes, thank you so much for adding that. Amen. That's all I'm going to say, right? I do believe this is patience and understanding, and that's why I want us to take a moment, as you know. We're just going to take a mindset moment here. Let's take a deep breath. We've learned a lot so far about the rules of the game. And it's also important to acknowledge our relationship with the game, right? So there's two questions that I'm going to invite everyone to just ask ourselves, right? Especially if you have pen and paper, if any word comes up, I invite you to write it down. The first question is, what fears and feelings towards debt did you absorb growing up? Very important question, because as you saw, there's different types of debt, and some of those types of debt are actually going to be our best bet to get to our goals. So if we have an aversion towards debt, that can represent a big obstacle on our capacity to use debt to our advantage. So that's why it's important to ask ourselves that first question. And the other question is, what financial habits do you need to have to manage your debt effectively? And Enrique shared a couple of tips here and there about those financial habits, right? Monitoring constantly, right? Being organized. He also shared you can use software, right? Nowadays, we're not alone in this game. We can embrace technology and make our lives a little easier that way as well. So these two questions, I would like to invite you to, as you go this week through your homework, if you want to rewatch the recording, if there are some things that you would like, I want to get some clarity about that topic, please make sure that you think about these two items, right? Because those connect a lot with our capacity, our confidence in ourselves to manage our debt, which is a very important piece of the puzzle as well. So here, the reason why we ask that is because this is going to lead us to facing our numbers, right? Ultimately, we got to know, okay, how much debt do I have? Let's take a look at it. Let's be as strategic as possible. So when it comes to facing our numbers, there's going to be two places where we're going to be working on, right? Our first place, it's going to be, and if you worked on your homework from last session, that piece is ready. One is our budget or our spending plan. And one thing to look there is my income enough to cover all my expenses? Is my income enough to cover my debt? When we have situations where that might not be the case, that's when sometimes we encourage people to consolidate debt, bring everything together so that you are only paying for one institution, right? And you can negotiate a much more manageable monthly payment if that is something that you need. The other piece is expenses, right? Are there any expenses you could be letting go of to be able to allocate more money to pay off your debt, right? So kind of playing around like a Tetris game when we're looking at our budget. So that's in terms of budget, the things that I'm going to encourage you to start looking at. And then the other piece of facing our numbers is going to be our balance sheet. Your balance sheet is going to be your last handout or your last homework of this series. So we're going to be sending that tomorrow. And it's basically a way for you to visualize everything, right? Everything you own and everything you owe. And when we're talking about everything you own, we're talking about your assets, right? What type of assets do we own? And one of my favorite questions, what type of assets do you want to own? Enrique covered a home, right? If owning a home or owning a business or owning et cetera, is part of your goals, like we talked about on week 1, then let's include that. Let's consider that and let's start connecting the dots. What type of debt am I going to need to think about to get to that asset? The other pieces are liabilities, right? So that's where we're just talking. Let's list all of our debt. And that's what we're going to do for our homework, right? We're going to identify, we're going to visualize how much debt do we have, right? Just to take a look at all of it and start getting organized. And then here, considering also, could our debt be considered an investment in our future? Sometimes when we look at our debt, we're like, this is a lot of debt. But if you think about like student loans, if you think about mortgage, that is what we call good debt, because that debt, is an investment in you, in your future, and in your financial goals. So always keep that in perspective when you're looking and paying off that debt slowly but surely, right? And then our last question when we're looking at our balance sheet is going to be, how is my debt being managed? Which is the point that I'm going to talk about in just 1 second here. So that's really what we call debt management strategy. And when you're going through your homework, where you're listing everything, I'm going to encourage you to think as a financial advisor, right? Like how we've been talking about throughout all these series. It's about looking at those numbers without judging yourself, without judging, oh, that's bad debt, I shouldn't have it there. No, remember that our past doesn't determine who we are. It determines who we can become, right? So get those tools, look at that debt, and let's start identifying how can we pay it off, right? What's the best plan for us? And again, it's a numbers game, right? Looking at your numbers, they're straightforward, right? They're just there to tell you a story. It's up to us to look at the story Be patient, be understanding, be compassionate, and slowly but surely start paying it off and utilize some of the great resources that were shared today, right? Like Mint, Credit Karma. What was the other very good one? Self Inc. or Self Lender. Any tools that are going to help you in your path, let's go for it. And along with those tools, what I'm going to encourage you to do is to think about your debt management strategy. How do we do that? We do that, one, by listing everything we owe, every single thing, right? Even friends and family. I didn't pay that to my friend. Every single debt, let's list it. Then we need to identify minimum payments, interest rates, and one thing that I would like to add, especially for credit cards, cut-off dates. So at the end of the day, our credit score is not going to be affected in the middle of those. If we haven't paid, or if we paid a big portion of it, or we wait till the end, it's only if we don't pay at the cut-off date, that's where it messes with our credit score. So we need to add that to our list. Then the other piece is reviewing our budget. You already worked on your budget, so you have an idea, okay, how much wiggle room do I have to pay off my debt? And therefore you can start incorporating your debt payments. You can start paying a little more if you can, or you can identify, hey, this is too much for me to manage. I might need to bring everything together and consolidate. That's also a possibility. And then lastly, identify the best payment plan for you. Today, I'm going to share with you 2 types of payment plans to see which one you like best. One type is called the avalanche strategy. So in the avalanche strategy, what we focus on first is the most expensive debt, right? So if we make a list, we're going to put the highest interest rate at the top. So that's the debt that we're going to prioritize, right? This is considered the most cost-effective strategy, because as you can see here, let's say that my biggest debt in terms of dollar amount is my student loan, but the interest rate is very little. So let's prioritize the highest interest rates, because that's technically a little more expensive. So that's why the avalanche strategy works for people that want to be more cost effective. Then the other strategy, and here let me pause for a moment. What we mean by the avalanche, right, is that you should be paying all of your minimum payments for each of the line items. And once you pay the one at the top, that minimum payment you had there is not like we're going to celebrate and we're going to spend it on something else. What we recommend is take that minimum and add it to the next line item. And then once you pay the second line item, all that minimum chunk, add it to the third one. And therefore, you just start adding all of that debt budget. You start going down the list until you pay everything off. So that's why we list everything, because you're supposed to be adding it to the next one and to the next one. So now let me share the snowball strategy. This strategy is a little different. So this strategy focuses on dollar amounts, not on interest rates. So this strategy focuses on paying the smallest debt first. This strategy psychologically might help people that are feeling a little more stressed about their debt. Just to looking at all these different items, it might feel better to start just with the little items so that you don't see them anymore. And that works as well. At the end of the day, the best method, just like we talked about the best software, the best card, the best strategy, is the one that you can stick to, the one that you can be committed to. If you are a person that needs more motivation to pay off debt, then stick to the snowball strategy method. But if you say, no, I actually want, let's pay with the most expensive one first, that works for me, it's really up to you. Everybody has a unique journey. So you should choose what works best for you. And you're also welcome to utilize, and I'm going to share it again in our resource list. NerdWallet has a very good debt payment calculator that can tell you, okay, if you pay this amount a month, this is how much time it's going to take for you to pay it off. And you can play around with it and add that to your debt payment plan. So that's really the biggest, when it comes to your homework, when it comes to looking at your balance sheet and all of your debt, it's going to be very important for you to consider which payment plan you're going to try, which one works for you. And again, right, just be patient and understand it. So there are different resources that we have been talking about today. Again, we're going to add more to the list, but it's very important to stay organized. Very, very important. And if you have a hard time staying organized with everything you owe, let's use technology. Why not, right? So that's one piece. The other piece is you can work with a team. You're not alone in this space. And particularly, we have a list. Let me share it. I have a list of debt management nonprofit organizations where you can be matched with a debt counselor if you really have just particular issues when it comes to your debt that you want to talk to someone about. So I have a list of 4 different nonprofits. A lot of them offer free counseling if that's something that you're looking for. I'm going to be sharing it in the chat in just a moment. But that's one of the pieces that we also wanted to share with you, right? This is not something that you need to do alone. And then always keep learning, right? We have shared some of these books before. One of the books that I really like when it comes to debt, it's a very old book. It's an oldie but a goodie. It's called The Richest Man in Babylon. This book, if you have a hard time kind of working towards your debt, that book can offer a lot of motivation because it talks about the honor that is included when you're paying off your debt. Even if it's slowly but surely, there's a lot of honor in that exercise. So it's important to also celebrate every minimum payment that you're paying, right? That's you should feel like you're there, you're in the path, and that's important. So here we're almost at time. So let me share before we go through Q&A time. So let's recap. What's my next step? Okay, so homework. Again, bring awareness to your self-money talk, particularly when you're talking about debt, right? We've talked about it before. Let's keep at it. Then the other piece is going to be for you to work on your balance sheet. If anybody wants me to show it now, I'm happy to do it. Just add it in the chat if you want to show it now, or otherwise you're going to see it tomorrow in your email. And then just, again, sharing more resources. Don't forget, we shared Mint, we shared NerdWallet. You're also welcome to check our website for other courses. Enrique mentioned one that we did with him. That one is in Spanish, but it's about improving working on separating business and personal. And we talked about business credit score for those people that have had some questions about it. We have to do it in English, Enrique. That's what I just realized. But we do have some very good resources in our QuickBooks and Financial Empowerment tab. We have other webinars that are recorded there for you. And here, what I want to do now is jump to our Q&A. But before, I want to leave you with this beautiful quote. It's one of my favorites, and it's from The Richest Man in Babylon. We've learned a lot today about this game of managing our debt, paying it off. And again, this is a marathon, not a sprint. There's always more that we're all learning, right? We're right there with you learning as we go. But if you have that determination, where the determination is, the way can be found. It's really up to you to ask, like you've been doing today. Ask and take as many resources as possible and identify what strategy you can stick to. And that's the strategy that we want you to choose. So thank you. I just want to thank you for being here with us, and thank Enrique. Before we jump to Q&A, I'm going to just stop the recording. Enrique, is there anything you want to add before we jump to Q&A and stop the recording?
I would just say if you have any questions or you want to have any follow-up, but you can always reach out to Irene or to Weave, or you can also reach out to me. I'm open to any questions as well. I will share my contact information in the chat so that people can reach out.
Perfect. So we're going to stay here for a little bit, but for those that are watching the recording, thank you for joining us, and we'll see you soon.